You're sitting in front of your runway spreadsheet, and the numbers are doing that slow, ugly drift towards zero, which is when most founders make the same painful mistake. You assume innovation only costs money, and you forget that in a lot of countries, innovation also comes with a receipt because governments quietly built cash-back systems for R&D that many startups never claim. Here's the uncomfortable truth that hits like a late invoice. Two startups can build the same product, burn the same salaries, run the same experiments, and one of them gets tens or even hundreds of thousands back, while the other one gets nothing, purely because one founder knew how to document the work and ask for the money. My name is Hector, and I write practical startup finance playbooks that turn confusing rules into cash you can actually use. The problem is that most innovation incentives are designed like a maze on purpose, because the people who wrote them assume you already have accountants, lawyers, and a CFO who speaks fluent tax code, which is hilarious when you're three people in a co-working space trying to ship a product before your next billing cycle. And what makes it worse is that founders tend to hear about these programs only after they've already spent the money, already lost the documentation, and already set up their bookkeeping in a way that makes the claim 10 times harder. So stay with me, because by the end of this video, you'll have a founder-friendly system to figure out what qualifies, capture proof while you build, and pull money back from your innovation without gambling your company on a sloppy claim. The first thing you need to understand is that getting money back doesn't mean one single magic program, because it's usually a stack of options that behave differently depending on whether you're in the US, the UK, or the EU, and depending on whether you're profitable, pre-revenue, or scaling fast. In the US, the headline tool is the federal R&D tax credit, and the part founders miss is that if you're a qualified small business, you can often use it against payroll taxes, which is basically the closest thing to cash now that a tax credit can be. The IRS explains that the election amount for the payroll tax version was increased, and it can be up to $500,000 for eligible tax years, with the credit applied against the employer share of Social Security first and then Medicare when applicable. In the UK, the big shift is that for accounting periods starting on or after April 1st, 2024, most companies claim through a merged scheme that uses an R&D expenditure credit approach, and the government guidance puts the merged scheme expenditure credit rate at 20%, while also carving out enhanced support for certain R&D intensive loss-making SMEs. Across Europe, several countries run powerful R&D incentives that can feel like cheat codes if you're building there, including France's Crédit d'impôt recherche, which is widely described as 30% of eligible R&D spend up to a threshold and then a lower rate beyond it. And France's own tax authority describes the 30% up to $100 million structure in its incentives overview. Germany has its own R&D tax allowance system, known as Forschungszulage, where the core idea is that eligible costs get a percentage subsidy through the tax system, and the OECD's incentives portal summarizes a 25% funding rate for eligible costs, with additional parameters and caps depending on the rules in force. The Netherlands has WBSO, which is essentially a way to reduce wage tax and social security contributions connected to R&D work, and the Dutch Enterprise Agency describes it as an R&D tax credit for businesses carrying out R&D projects. And then there's the non-dilutive funding side, which founders love because it doesn't touch your cap table, like the US SBIR and STTR programs, where the official SBIR site lays out typical phase ranges that can be meaningful money for a small team, especially when you're doing deep tech or anything that looks like real applied research. Finally, at the EU level, there's the EIC Accelerator, which the European Innovation Council describes as offering a grant component below $2.5 million plus equity investments up to $10 million for eligible companies, and that combination matters because it can fund both technical risk and scaling. Now, before you get excited and start mentally spending free money, you need the most important mindset shift in this whole video. These programs do not pay you for being a startup, and they pay you for doing specific kinds of uncertainty-heavy work documented in a specific way, with costs categorized in a specific way. That's why founders who treat this like an afterthought usually get disappointed, while founders who treat it like a repeatable process build a real advantage, because every dollar you recover extends runway without raising another round. Here's how to turn that into something you can actually execute. When most founders hear R&D, they imagine white lab coats and microscopes, which makes software founders assume they don't qualify, and that assumption alone costs people a shocking amount of money. In most regimes, the spirit is not, "Did you invent a new app?" And it's,
Did you attempt to solve a technical problem where the outcome wasn't obvious at the start, which includes building prototypes, testing architectures, dealing with performance constraints, security constraints, data constraints, hardware integration, or any hard engineering problem where you had to experiment your way forward?
So instead of asking, are we innovative? Ask, where did we have technical uncertainty? And then look for the work you did to reduce that uncertainty. If you've ever rewritten a pipeline because latency was unacceptable, changed your model approach because the first one failed, built an internal tool because nothing off the shelf worked, or created a new method to meet a spec, you're already in the territory where credits and incentives often live. The reason this matters is that founders usually remember the big wins, like the demo that finally worked. But incentives are built around the messy middle, like the 3 approaches that failed before the one that shipped, because that's the actual R&D story. Here's the practical move that unlocks everything else. Create an R&D map of your product that ties every major technical milestone to a short statement of uncertainty, a short statement of hypotheses you tested, and a short statement of what you learned. If you do this monthly, it takes under an hour, and it turns your engineering chaos into a narrative that tax authorities and grant reviewers can understand without being inside your codebase. If you want this channel to keep making founder-friendly systems like this, subscribe, because I'm going to keep translating boring finance mechanisms into runway you can actually feel, and the next videos will go deeper into what costs count and how to avoid the traps that get claims denied. Now let's talk about the real reason people miss out, which is not eligibility, and it's documentation. The fastest way to lose money you could have recovered is to wait until year end, open your GitHub, stare at your payroll, and then try to reconstruct what happened. Even if your work qualifies, your evidence will be mushy, and mushy evidence turns a claim into a risk, which means your advisor gets conservative, or you get aggressive, and both paths lead to pain. You want your proof to be a byproduct of how you already build, which means you create a light system that piggybacks on tools you already use. If you use Jira or Linear, you tag tickets that are genuinely uncertainty-reducing work, and you keep the acceptance criteria focused on the experiment, not just the feature. If you use GitHub, you keep PR descriptions that explain what problem you were solving and why it wasn't straightforward. If you do demos, you keep a simple running doc of what failed, what changed, what we learned, because learning is the point. Then you connect that proof to money, because incentives are claims about cost, not vibes. In many programs, the largest eligible cost bucket is people, which is amazing for startups because payroll is usually your biggest expense. The catch is that you need a defensible way to allocate time, and you do not need to turn your team into timesheet robots to do that well. What you do need is a reasonable, consistent method, like monthly percentage allocations by role and project, backed by ticket tags and sprint notes, so you can show that your CTO spent, say, 70% on R&D tasks, while your customer success person spent 0%, and that difference is supported by actual work artifacts. The same approach applies to contractor invoices, cloud costs that are directly tied to experimentation, prototype materials, and testing costs. But the golden rule is always the same. If you can't explain the why in one sentence, don't force it, because forced costs are where audits come from. Now we get into the part where founders waste the most time, which is picking the wrong path for their situation. If you're a US startup that is not yet profitable, the payroll tax offset angle is often the most founder-friendly, because it can reduce payroll tax liability rather than waiting for future income tax, and the IRS has specific rules around how that payroll tax credit works and where it applies. If you're in the UK, the merge scheme means you're generally thinking in terms of an above-the-line credit that's taxable, and you're planning around cash impact after corporation tax, which is why founders should look at the net benefit, not only the headline rate, while still anchoring to the government's merge scheme description and eligibility conditions. If you're operating in France, the CIR can be significant enough that it changes hiring decisions, which is why founders building there often treat it like part of the financing plan rather than a nice bonus. And the French system's core percentage structure is documented in official incentives materials. If you're in Germany, Forschungszulage can be relevant even when your corporate tax position is limited, depending on how the mechanism is applied in your specific case. And the OECD's summary is a good neutral starting point to understand the core rate concept before you get into local implementation details. If you're in the Netherlands, WBSO is often most tangible as a reduction connected to wage tax and R&D labor. and the Dutch RVO description is a clear way to understand what it is before you talk to an advisor about your exact projects. And if you're deciding between tax credit effort and grant effort, here's a founder reality check. Grants like SBIR can be amazing, but they demand proposal writing and compliance discipline, while tax incentives demand documentation discipline. And the best teams pick the one that matches their operating style instead of chasing whichever one sounds sexiest on Twitter. If you want a simple heuristic, here it is. If you already have strong technical artifacts and you can cleanly categorize costs, tax incentives are usually the faster win, while if your work fits a public mission and you can tell the story well, grants can be worth the overhead, especially when the award sizes align with your development roadmap. The SBIR program itself lays out the three-phase structure and typical ranges, which is useful when you're matching a phase 1 scope to a proof of concept milestone rather than trying to fund your entire company with one application. At this point, you might be thinking, okay, so I just claim it. And this is where I need to save you from the biggest hidden danger in this space. Bad claims don't just fail, and they can create headaches that distract you from building, because if you get pulled into months of back and forth, your runway bleeds in the most expensive way possible, which is founder attention. The most common mistake is people trying to claim everything engineering touched as R&D, which is not how these systems are meant to work, and it's also how you end up with a claim that can't be defended. The second most common mistake is relying on a consultant who sells you a number first, and then tries to reverse engineer a story to fit it, because that incentives the wrong behavior, and you want the opposite, which is story first, cost second, claim last. So your job is to build a claim that is boring, because boring claims survive scrutiny. A boring claim has a clear project boundary, a clear statement of uncertainty, clear evidence that you experimented, and a cost allocation method that looks like a reasonable human made it and applied it consistently. A boring claim also respects the difference between genuine experimentation and routine product work, because once something becomes routine, it stops being R&D, even if it still feels hard. Now let's talk about the part founders love, which is turning all of this into actual cash timing. Credits and incentives often arrive later than you want, which means you should plan them like a financing event with a lead time, and not like a lottery ticket that might land next week. That planning changes decisions, because if you know that a claim will hit in, say, months rather than days, you can still hire, but you hire with a buffer, and you don't make payroll dependent on money you haven't secured. This is also where teams get a huge edge by making the process repeatable, because the first time you do this, it feels like extra work, while the second time it feels like a routine close process, and by the third time, it becomes a quiet competitive advantage that lets you spend more on experimentation than your competitor without raising more capital. If you're finding this useful, hit like, because it tells me to keep making content that is practical runway engineering, not generic startup motivation. Now let's bring in the non-dilutive funding angle, because a lot of founders hear grants and assume it's either impossible or not worth it. And both of those beliefs are usually based on watching someone do it badly. In the US, SBIR and STTR exist precisely because the government wants startups to take technical risks that private capital might avoid early on, and the official program site lays out typical Phase 1 and Phase 2 ranges that can fund real technical work if you scope it correctly. The key to grants is that you don't apply with your entire vision for world domination, and you apply with a sharply defined technical objective that you can actually complete under the grant's expectations, with deliverables that a reviewer can evaluate without falling in love with your branding. That's why founders who win grants often write like engineers, not like marketers, because they are selling credible execution under constraints. In Europe, the EIC Accelerator is one of the big names founders chase, and the EIC describes it as support for developing and scaling innovations with grants below $2.5 million and equity investments up to $10 million, and that's meaningful because it can bridge the gap between a validated prototype and an actual scale-up push. Here's the move that makes grant applications less soul-crushing. Instead of writing from scratch, you build a reusable technical narrative document that includes your problem, your approach, your evidence so far, your risks, and your milestones, and then you adapt it to each program. That's basically the same narrative discipline you need for R&D tax incentives, which is why founders who do one well often become capable of doing both. Now we land the plane with the part that turns this from interesting into you actually get money back, because the biggest gap is execution. If you want to capture innovation cashback like a pro, you set a quarterly ritual that has 3 outputs: an updated R&D map, a categorized cost snapshot, and a list of programs you're targeting based on where you operate and how you're funded. When you do that, you stop relying on memory. You stop relying on advisors to magically read your mind, and you start treating innovation recovery like a system. And here's a counterintuitive but powerful benefit. This process makes you a better founder, even if you never claim a penny, because the discipline of stating uncertainty, testing hypotheses, documenting learning, and tying work to outcomes is literally the operating system of great engineering teams. Now, quick reality check. Because I don't want you to hear free money and get reckless, you should always talk to a qualified tax professional or advisor for your jurisdiction before filing anything, especially because details change and the best structure depends on your facts. The point of this video is not to replace advice, and it's to make sure you walk into those conversations prepared, because prepared founders get better outcomes and pay less for the same quality of work.